about it. The dollar was so strong in 2022 that it basically took the wind out of the sails in gold. Now, I still think gold, again, if you compare it to the S&P 500 or Bitcoin, it was an amazing performer. In fact, I think we'd all rather have just had our money in gold this year versus any of those other assets. So I think that's the positive of it. I do think now that the Fed is kind of beginning to waver a little on these 75 basis point hikes and likely going, they did 50, they'll probably do 25 and then maybe pause. That's going to continue to keep the dollar under pressure, which means gold in 2023 should be a great performer. And again, what this shows us here is basically where gold started was right over here at around $1,775. It's up 25 bucks on the day trading at, or 25 bucks on the year trading at 1,800. So it actually, assuming it holds this into year end, it'll basically be flat to positive on the year. Now, what we've seen is what actually went on in the late 70s. So gold had the same sort of movement with this run up from 2018 to 2020, and then this sideways to lower chop for about 2 years. And if you go back again to 73 to 75, there was a big up move. Then 2 years from 75 to 77, you had this sideways chop. And then basically starting in 78, there was a massive move up in gold. And I'm expecting that to happen. In fact, if we look at some parallels here, what we can see is that gold, for the most part, has been holding inside of this little range here. And I can bring that out. And that's what we call a bullish consolidation. So you have an up move and then essentially digestion of that up move. And what we're looking for is a breakout above basically 2000, 2075, and you should be off to the races. So I think as a technician, this year is almost what the doctor ordered. I mean, it's not the best. As an investor, I would have loved to have seen gold up 20%, but this is really following the track of the past period where inflation was an issue in terms of what it did. And that tells us that there's likely significant upside coming up in the next year or two. Levels very, very clear now, right? We have basically this low here connected to this low. So right now you're looking at your downside of around 1,600, give or take. That's what we talked about, obviously, in the past as being the downside, and that did turn out to be the low pivot. On the upside, really all you have now, and again, there's going to be minor levels of resistance, but this trend line area right up here, you could even draw a trend line that just connects the double tops right here. I would say somewhere between 2050 and 2070, that's going to be your big resistance area. If gold can push through that, it's got clear sailing for a big short squeeze. I think it's one of the most underinvested assets out there. I mean, if you go back to the Bitcoin craze, the crypto craze, I still remember being told that gold was done. It was over. No one wanted it anymore. And that tells me that there's not a lot of money in there. So at some point, investors will flood back, and that's where you get that parabolic move that could easily take us in 2023 to, to $2,300, $2,500 an ounce, maybe even higher. I think investors have to recognize that, the labor market has stayed strong at this point, but I do think that there's a cliff dive coming in that sense. So I do think the Fed will hike at least one more time, probably in early 2023. If we look at the symmetry of their moves, they did a 25 basis point hike, then a 50, then 475s, and they've done a 50. So they're almost coming down the mountainside where it leaves them at least 25 more basis points. I think that one of the reasons why the labor market has stayed so strong is that businesses, and generally small businesses, have been very reluctant to lay people off because it was so hard to find employees, right? So when you struggle to find employees, which is what happened over the last year or two, you're very, hesitant to say, okay, well, the business is slowing right now, so I'm just going to lay everyone off. You say, well, what if it picks up? How am I going to find a good quality employee again? And so I think that's what you're dealing with right now, which is why the labor market has stayed so tough. But I do think there will be a point where even small businesses, and we've seen this, we've seen Meta lay off a ton. We've seen Google announce layoffs. I mean, the big companies that understand business cycles, they are laying off. It's just waiting to come to the small business side. And I think in 2023, we're going to see that. And the Fed will basically stop hiking rates after one or two more hikes. Now, the key here is that the Fed, because they were offsides and called inflation transitory, and they got behind the curve, they're going to be unbelievably hesitant to lower rates. They're going to hang on and say, listen, we don't want to lower too early. We don't want to create more inflation. And so I think they're going to wait too long to stimulate. And we're going to have a very, very tough recession by the second half of 2023. There's no doubt about it that the Russia invasion, the supply chain, I mean, different things like that created additional headaches for the Fed. But, if you're just looking at them bringing down inflation, yeah, I mean, you give them a good mark for that. But you also have to ask yourself, why was inflation such an issue? Could it be that they printed trillions of dollars and had interest rates at zero for so long a period? I would tend to agree. And I think that, it's easy to say, oh, they get a B plus or an A for getting it under control. But it's like, well, they are the ones that created the problem in general in the first place, right? So again, that's a tricky one. But this is the kicker on inflation, is that bringing inflation from 9% down to 5 or 4%, that's the easy work. That's like, if you have to run a mile, maybe the first half, 3/4 of the mile, we're all doing all right. It's the last little bit from 4% to 2% that I think is going to be unbelievably hard to get to. And that's going to make it very hard for the Fed to stimulate in the future. The charts here. This is the S&P 500. And the first thing I go to is this trend line here. If you connect this high to this high here, which is the last two, the highest pivot, the all-time high and the secondary high, and just stretch that down, the market has had very much trouble getting through that line. And you can see that again, in the near term, we're starting to break down again from that level. So to me, I look at this market and I say, okay, has the market fully factored in a recession? Has it fully factored in the fact that it's going to be a longer recession? If you think about it too, the economy has been in overgrowth mode for such a long time due to stimulus. It means that we almost need a long period of undergrowth to bring it back to the mean, right? That the average for the longer term growth. So I have it penciled in that probably in the first quarter of 2023, we're going to head down to about 3,400 on the S&P 500, which brings us to the pre-COVID high just before the big dip on COVID. And then I actually think that there's a longer trend line here that we can actually go back literally years. And I think this will be my target for 2023, that I do think we visit this 3,000 level on the S&P. So that puts us down 20 to 25% from current levels. And I think, again, that's really where I would start to get interested, maybe potentially buying a little bit. I think you have to look at it like there's obviously a recession for some people. I think lower middle income with inflation, I mean, they're hurting. There's no doubt about it. Now that the stock market has come in, crypto's obviously collapsed. I think that creates more pressure on middle and upper income individuals that have investments as well. But again, GDP came in. It was just revised the other day for this quarter or the past quarter. And that was actually very, very strong. So I don't think per the norm, we're officially in a recession. But I do think we will get to that point in 2023. And I think it's going to be one of those scenarios where the Fed is kind of saying, oh, the labor market's still good. This is still good. This is still good. And I really think it's going to be very sudden where we fall off a cliff. If you look at delinquencies in loans, car loans, housing has collapsed. Remember how many jobs houses fuel, building houses. You got plumbers, electricians, builders, roofers. All of these things are just grinding to a halt. And people had a lot of money saved during COVID. So they were saying, okay, well, I'm okay for now, but there will be a cutoff. There will be a cliff dive at some point in 2023.